Welcome everyone to the 2026 Financial Planning Guide update. My name is Jacob Schatz. I'm a partner at our firm, IntentGen Financial Partners. This is a fun day for us. Typically, we're going through investment and economic updates, and today we get to jump into the financial planning side. Before we do, our friends from compliance and their regards. And we're going to be going through tax charitable planning, retirement planning, legacy planning, and then wrapping it up with some risk management ideas. This plan is typically a 55 to 70 page document. Our team knows it in and out, but we've pulled a few slides to go through and extract as we think they're impactful and important to you. I'm joined today with two of my colleagues, Mickey and Cole. They are both senior planning coordinators. We've built out our team with advisors, investment managers, service coordinators, as well as planning coordinators to best take care of you in your financial planning journey. Our firm had a great year last year, and so some updates to share with you. We passed 800 million in total client assets. We've engaged and directed 930 financial planning partnerships. So that's nearly 1,000 households that are intentionally and planning purposely with their money. Uh, we helped facilitate over 2.1 million in charitable gifts last year, and our clients referred 55 referrals to our firm. We've also engaged with 30 nonprofits in the local area, designating about 210,000 through those organizations, the relationships, and the events they did. And the number is at 1,600 and growing, but assisted hundreds of clients in once-in-a-lifetime special financial events like retirement, college education, second homes, bucket list experiences. And we're looking forward to continuing to grow that list. As we jump into some of the legislation and reform updates, I'm going to let my partner Cole jump into that.
Yeah, thanks, Jacob. Some key updates for this year that we wanted to go over, we have listed here on the next two slides. But to start off, as many of you may know, the One Big Beautiful Bill, or OBBB, was signed into law last July. This extended the personal tax provisions, which have been in place since 2017. And with that, we're seeing more clarity around tax policy, which provides more certainty and clears a path for more planning opportunities moving forward. In addition to some continued tax policy, the federal estate tax exemption and lifetime gift tax exemption were both increased from 13.99 to $15 million per person, allowing for more room to potentially move assets outside of a taxable estate. With that, the annual gift tax exclusion actually stayed the same, and that remains at 19,000 per person per donee for 2026. This year also brought along some changes to retirement plan contributions. Specifically, there is now a super catch-up contribution that is available for any individual aged between 60 and 63. This allows for catch-up contributions of up to 11,250, as opposed to the normal 50 plus catch-up contribution of 8,000. That being said, with Secure Act 2.0, where the catch-up contributions go is now determined on each individual, not household income. If earned income was over 150,000 in 2025, then catch-up contributions in 2026 will have to go to a Roth IRA or after-tax Roth 401k. In terms of personal tax liabilities and income deductions, 2026 brought some adjustments as well. The alternative minimum tax threshold was lowered to $1 million for joint and 500,000 for all other filers. State and local tax or SALT deductions limit was increased from 10,000 to 40,000, and there is a new senior deduction of $6,000 per person, which is available to any individual over 65 and have a modified adjusted gross income below 75,000 for single filers and 150,000 for married filers.
And Cole, for those Roth 401k catch-ups, we're actually looking back at 2025's income for this current year, correct?
Yeah. Yep, it'll be based off of 2025 income for the year ahead. Perfect. As part of our holistic approach to planning, we take these changes into consideration along with this slide and the next slide in our guide, which include the 2026 federal tax provisions as long-term capital gains tax rates and standard deduction amounts. We take all of these into account in order to try to identify any potential tax saving opportunities as you meet with us and our team. Some of these strategies, they're listed here, but they also include IRA to Roth conversions, tax loss harvesting, and managing capital gains. Really, while these are all strategies that are available to any situation, that doesn't mean that it's for your specific situation. So it's important to remember that not all are the same and not all tax years are equal. Next, I'll let Jacob go into tax efficiency as it pertains to investment assets and asset location.
Thanks, Cole. One of the things that we look at when we're developing portfolios for everyone is not only risk. So, where is your money being set up from an asset allocation standpoint? But the second point is asset location, which some could argue is just as important for taxation. So within your portfolios, typically you'll see a variety of asset classes, but some of those are more efficient from a tax perspective than others. Municipal bonds, those are some of the most tax efficient asset classes. Their income is federally tax exempt and some may be state tax exempt. Equities through exchange traded funds that have, or even active managers that have lower turnover, those are going to see limited capital gains exposure. And then as we start to get less efficient, that's where we have maybe more actively managed funds that have higher turnover. So we're seeing higher capital gains distributed. REITs, real estate investment trusts, those can have non-qualified dividends with capital gains. And then depending upon the yield, we have taxable bonds, which will be taxed at ordinary income. So not saying that any of those are better or worse than others, it's just more important for where they're potentially held in terms of the investment type. So our Roth IRAs, if available to you, those are typically higher growth strategies. So global equities, high growth. It's okay to have them actively managed, maybe higher turnover because we're not recognizing those gains. The the allocation of tax inefficient asset classes tends to be in our tax later bucket through IRAs, 401ks, 403bs. So we can have some of those higher yielding bonds since we're not recognizing that income until we do distributions. We're seeing global bonds, maybe some dividend equities. And then we would round out the portfolio allocation through our taxable bucket. So this could be an individual investment account, a joint investment account, a trust. We really look at whether we would use tax exempt or taxable based off of a person's tax bracket, perhaps having, again, lower turnover funds with less capital gain distributions. And co-pivoting from the tax side of it into charitable giving, and certainly another way to be tax efficient with your money. Why don't you walk through some of the examples or ideas there?
Yeah. So we really wanted to call this slide out because charitable giving really is becoming more strategic. One of the tools in our guide that we have is this chart that you see here, which allows you to compare and contrast some different methods for charitable giving. Tools such as donor advised funds, for example, can provide flexibility and tax efficiency for individuals who are making gifts. And for consistent givers, bunching donations into a single uh, donor advised fund contribution may make sense in a high income year. So if you bunch multiple years of giving into one contribution, you get a larger deduction in that tax year, and then you get to give from the donor advised fund as time goes on. And with that, not only donating cash, but you can also donate appreciated assets. And what that allows you to do is it allows you to make the contribution and get the deduction for that, as well as avoid paying taxes on those capital gains on those securities. So it's kind of a win-win. Um, for the next slide from charitable giving, we'll transition into our retirement planning. Jacob, we can go to the next slide. For retirement planning, when we look at retirement planning, we find a lot of conversations come down to, or a common question that we have is, am I on track? And when answering that question, we take into account a variety of factors, such as retirement savings, income needs, and how long assets are needed to last. We combine these with allocation and inflation percentages into a Monte Carlo simulation, which is 1,000 scenarios, and we use that as sort of a baseline for planning. Rules of thumb that are included in our guide here are great, and they can really be beneficial for saving targets, both how much and where. But plans really should be personalized and be flexible over the course of your lifetime. One thing Jacob touched on previously, and that we have here in front of us for retirement purposes, we really want to be mindful of not just the asset allocation, but also location when saving in retirement. Here we can see three different savings buckets. Included are the taxable, pre-tax, and after-tax. We also refer to these as tax now, tax later, and tax never in our tax efficiency checklist. As part of our planning process, we look to help you ensure assets are not only tax efficient for your lifetime, but also for any potential beneficiaries that you list as well. Tools such as this and our tax efficiency checklists allow us to obtain a bird's eye view of assets and their location, where we can provide guidance on savings based on your goals and objectives.
Awesome, cool. And before you jump into the next one, I'll put the additional disclaimer too. We're certainly not CPAs, so when it comes to tax efficiency, tax distribution, marginal tax brackets, charitable giving, we're versed and knowledgeable enough on the topics, and that's where we would engage and personalize for you, and then work directly with your CPA to figure out what is the best strategy as we look at all these different examples and ideas to think of.
Perfect. And then, yeah, finally, I know touched on it briefly in the updates, but I did just want to point out here, slide 30 has all of the annual contribution limits for both employer-sponsored plans and individual retirement accounts. So for the phase out there at the bottom for Roth IRA contributions, whether or not you're eligible for those, or we'll need to look to make IRA contributions instead. All right, on to Medicare. So I know I touched on tax brackets a little bit ago. Here's another bracket for you to look at. Um, Once in retirement, when you start taking money from the different accounts, one thing we'll want to be sure that we're monitoring is where the distributions are coming from. In addition to the federal income tax brackets and long-term capital gains tax rates, it is important to also be mindful of these, which are Medicare Part B and D thresholds for individuals who are either qualify for Medicare or within 2 years of qualifying for Medicare. Now, one thing to point out with these are based on adjusted gross income instead of taxable. So it's before any deductions on your tax return, which is a higher number. And if not monitored, could inadvertently increase your Medicare premiums when you weren't expecting them to. So this slide provides the 2026 figures, and then slide 42 also provides some important dates around Medicare, and if you're turning 65 and are looking to apply, just days that you should be aware of over the next year. That's it for me on retirement planning, and I'll pass it over to Mickey to go through estate planning.
Yeah, cool. Thank you very much. Jumping into the estate planning piece, we've talked about building your plan and getting things set up for your retirement, but then we have to have the conversation about what's next. And ultimately, that means planning for legacy and planning for your care when you're no longer in a position to make those decisions that are in your own best interest going forward. And so we look to make those decisions ahead of time while you're still sound of mind. And that comes with a lot of layers to it. Ultimately, we're looking at helping you get the correct documents in place so that you're ready to go and are confident and comfortable with your plan when you reach that point. It includes pieces such as setting up a durable power of attorney, as well as the living and healthcare proxies associated with that, so that you're putting the individuals you trust in those positions to help make decisions for your care when you can no longer make those decisions for yourself. And it also overlaps a lot with what we do throughout your lifetime in the tax efficiency planning, ensuring that we're minimizing those taxes where we can so that your assets go directly to the people and places that you want to benefit with your legacy when you're no longer here in the best possible way. So what we're looking at is ensuring that, your documents are in place, those executors and everything that you need to have for your trust are established. And we also help on the back end to ensure that the assets that are intended to go into those trusts and can are placed into the ownership of those trusts so that they are actually effective rather than just a document waiting out there. We're also looking for you younger parents to make sure that your minor children who aren't yet of the age of 18 or in the age where you wish them to have total control of those assets are in that position to be well cared for and directed as they continue to mature in an unfortunate scenario. And we're also looking to further extrapolate on your charitable planning during your lifetime by saying what to do with your funds, with how to benefit those organizations that you continue to associate with while you are still here, and make sure that you're getting the best possible impact for those planning pieces. It's about protection for your family plan and your wealth, as well as protection for your goals and lifestyle, so that you know where your money's going and who you're benefiting, and maximizing that option along the way. And in addition to wills, there's several layers to it, such as these in front of you, but there's multiple different types of trust, which we regularly touch base with our clients on an as needed basis based off of their unique plan. Not every type of trust is intended to be implemented for all plans, but there are many different types of trusts that can help associate and find a solution for different issues or concerns that you may have for your plan or for your estate taxes along the way. Many of those trusts are associated with getting around those exclusions in the estate tax limits, but there's also pieces that are associated with getting more funds to the charities that you want to benefit ahead of time, as well as ways to ensure that your children and next of kin are receiving those assets in the most efficient way possible, as well as continuing to enable you to maximize your plan while you're still here. One additional layer of protection isn't just for your estate, but also we're in the age of technology and we're looking to make sure that we're protecting your assets along the way. So we have a lot of general recommendations that we provide to clients and remind them on pieces to be aware of so that they don't fall victim to any easy or recurring scam that's going around. So we want you to be aware and looking for pieces that don't quite fit in any communications that you're receiving to help spot imposters, making sure that, if you're not receiving that caller ID, that you're extra cautious about the information that's being shared with you and what you're sharing back with that individual on the other line. Also, protecting your payment methods along the way. While many banks are pretty good about providing those cybersecurity protections, we want you to be aware of those items just in case it does fall through the cracks on those protection systems. So setting up pieces like reminders on your phone so that you can see when a payment goes through and confirm that that was something you intended your money to go towards are great things to do. We also want you to be pretty skeptical about, the free lunch that's given to you. Free trials, it's a pretty standard saying, but the free lunch isn't always free, and there's no such thing as a free lunch. Is that we want you to be aware of those things. A lot of people try to get around those pieces, and free trial is something that they're not intending to move forward with. But that does come with some risks as well as you're trying to navigate and choose which services benefit you most. And so those pieces associated with a real-time alert and making sure that your passwords are well created and complex, as well as regularly updated, are ways that you can help protect yourself online.
Thanks, Mickey, and thanks, Cole. Really appreciate some of the depth that you went into as we looked at tax planning, we looked at estate, we looked at retirement projections, and then just some of the risks along the way. As we walk through a planning relationship with you, we're generally going to go through four phases. First part is organization of getting all of your data and information correct. I think that's a good inventory to see how assets are allocated, to look at what goals are, and then we help shift into prioritization of what's most important to you. So the people and places that you care about, where are you spending, what are the short-term goals, what are the long-term goals, and then we walk through pieces of this planning guide to essentially map out what are the strategies and what are the most efficient ways to help you get there along the way, or through the accumulation phase or even the distribution phase. And the last phase is maximization, which we did hit on a little bit, is looking at things like risk, taxes, and expenses on investments to best help you maximize your situation. Our website is www.intentgen.com. This guide will be attached in the video link and then also is available on our website. So feel free to dive into that. Again, know that we know it in and out and are using it in your planning. But certainly, if there's something that sticks out to you that you want to dive a little bit deeper into or talk through, don't hesitate to reach out to any of your advisor or planning coordinator. Thanks so much for your time.